Hi guys, welcome to this week's weekly wrap from Rand Swiss, and as always we'll cover what happened in the week and how it might be affecting your investments going forward. Big news of the week was the US Federal Reserve Chairman Jerome Powell going up and having a little meeting with some legislators and discussing what he thinks is going to happen with the US economy going forward and what he believes is happening there currently. He basically, I think the main statement that we got from him was the fact that he's going to find, or he thinks that achieving a soft landing will be a difficult or challenging rather for the Fed. That pretty much says to me that there's more than a 50% chance the US is going to have a negative quarter or two coming up really soon, possibly enough to get us into a technical recession. That is, I think, something quite troublesome because it's going to affect not just the US, it will have knock-on effects around the world. We in South Africa are definitely not going to be able to escape. If the Fed is raising rates, we in South Africa basically have to follow. If we don't follow, what happens is the rand weakens. The rand weakens, causing high inflation because we import a lot of stuff, including oil, and that results in basically the South African Reserve Bank having to raise rates eventually anyway because of the inflation problem. And like I told you last week, if the US Fed is raising rates, it's to basically slow down economic growth. If we raise rates, it will also slow down economic growth. There is no way around this fact. It's one of those kind of like economic truisms. Higher rates, lower growth. You want to reduce inflation, you reduce growth by increasing interest rates. That is the mechanism. We also had some really big developments coming through from the Japanese this last week or so. I think this is a really big problem, but I'm going to spend a little time discussing it with you guys. The Japanese system is under great deal of pressure at the moment. The Japanese have been virtually stagnant in terms of an economy for the last 3 decades. What's happened there is that their population is aging. It's more than, I think, a quarter over the age of 65. Growth has basically stagnated since the late 1980s, early 1990s. You look at the Nikkei, it's basically been on a bare trajectory over the 30-year period from the 1990s till now. We've seen massive increases in the amount of debt the country has taken on. So the Japanese, I think, have in excess of 250% of their GDP in debt. And because they have such a huge debt burden, what the Japanese Reserve Bank, the Bank of Japan, cannot allow to happen is you cannot allow to have interest rates rise in Japan. You cannot allow 10-year bond yields, especially Japanese government bond yields, to rise. Why? Because if they rise, the Japanese government is going to pay a lot of interest to basically refinance its debt. Its debt is huge. It's 2.5 times plus its GDP per, as a country. That means if you spent all its money for 2.5 years, it wouldn't be enough to pay off its debt, right? If you have interest rates rising, let's just say 3, 4, 5% interest rates, let's use a huge example. That means the government, if it has a 5% interest rate on basically 2.5 times government debt, it would have to spend roughly 12 to 13% of its total GDP every year servicing that debt. It's a huge chunk of GDP. It's unsustainable, okay? So what the Reserve Bank of Japan, the Bank of Japan, does is it basically tries to target, it's called yield curve capping, it's YCC. It tries to target a maximum yield for the government debt in Japan. They target about 0.25%. Now with the US raising rates, and Europe starting to look at raising rates as well, we saw it's called UK do it already, at least tightening monetary policy across most of the world. What's happening right now is the Japanese yen is suffering because the Japanese government can't raise this. The Japanese Reserve Bank can't be raising interest rates because, like I said, massive amounts of debt. They're going to have real trouble servicing it if they have high interest rates. So they are experiencing quite a significant weakening in their currency. So over the last year or so, from about middle of 2021 till now, the Japanese yen is down about 30%. It's weakening, quite substantially. In the last week, we saw about $30+ billion in outflows from the Japanese bond market. This is a huge bond market. It's a $10 trillion bond market, okay? But even in a $10 trillion bond market, a $35 billion per week outflow is not sustainable because over a period of effectively, say 10 weeks, you're talking about 350 billion outflowing that was maintained. That's 3.5% of the total market. Even a $10 trillion market can't afford that. So they are experiencing quite a lot of pain from that angle. Unfortunately, like I said, they are stuck with this huge debt burden that they can't afford to raise interest rates on. So that is, I think, a really big issue that we need to be concerned about going forward. If the Japanese bond market explodes or collapses, and the Bank of Japan breaks, for instance, in a similar way to what we saw George Soros break the Bank of England, about 3 decades ago, the repercussions could be quite significant, especially in a market that is as fragile as it is at the moment. So we could be seeing quite a bit more contagion globally if something happens to the Bank of Japan. And also to see how serious the situation is, the Bank of Japan had to basically go out and buy like $81 billion of bonds recently in order to try and stabilize pricing in the market. And still, at the moment, we're still seeing Japanese 10-year bond yields significantly higher than the cap that the government's basically putting into play. So what's likely to happen is the Japanese yen's going to weaken probably to 150. If it does that, then we're probably going to see the bank having to capitulate in terms of its policy, and we could be seeing quite a lot of economic pain hitting the Japanese people. Okay, and in local news, we had our inflation number come out. It was 6.5. We expected something a little bit lower than that. What is interesting in the numbers was like what is causing inflation. We had, of course, petrol. We of course our transport costs, and we also had food coming through. The goods number, for instance, was about 9%. The services number was about 3%. Now, services are more dependent on wages, as you can imagine. Services pay people wages. They do services, and goods, obviously on stuff, and often a lot of that stuff is imported. It also indicates that it's very unlikely that our wages are keeping up with the inflation that we are seeing at the moment coming through. And that's going to be a really big problem for the country. I've been talking about this for quite some time. We are seeing inflation really going to hit the lowest income levels in South Africa. People that are dependent, for instance, on government grants or working for minimum wage. In South Africa, minimum wage is pathetically low. And that is going to cause a lot of disturbances. We've seen, like I talked about before, we will be seeing more and more uncertainty, more and more rioting, more and more unrest in the world. We already talked about the fact that Sri Lanka collapsed. The last week or so, there's been a number of riots in India, ostensibly about about a new recruitment for their defense force and a slight change to how people were going to be remunerated. The Indian defense force, it has major enemies. It has like Pakistan. It has the Chinese. It needs to be a more professional unit. It has a lot of people. It's very inefficient. A lot of people are viewing it as almost a pension plan. You get into the defense force as a government job. You basically stay there till you die, and you get a pension. That's the way they look at it. The government must have a more of an American kind of system. You get in for about 4 years. After 4 years, you go and join the economy. You're not going to be a soldier for life. And that caused a lot of rioting, people burn trains. And I think one of the reasons that we are seeing this kind of increased unrest is because food prices are coming up and because of a lot of issues in the subcontinent at the moment. I talked about the fact that Pakistan has lost its leader, replaced Imran Khan. Obviously, Sri Lanka has had the problems. Afghanistan right now, by the way, was hit by an earthquake, so there's more problems for that poor country. But we're going to be seeing that happen again in Africa as we see more and more people coming under food pressure, food pricing pressure. And so, yeah, that is another factor to be concerned about. Looking forward from now, I'm still looking at the market right now. I still think the market's being a bit, choppy. We are still a little optimistic. I don't see the real reflections coming through. So, for instance, we are seeing up and down days. Despite we having some really bad economic news coming through, we could easily see more downside from here. That being said, I've come to kind of a model for what I expect for the future. Again, this is not based on any kind of strong analysis. Just my view on what's likely to happen with regards to politicians and the pressure that's going to be placed on places like the Reserve Bank or, for instance, the Federal Reserve. In 2024, the US is going to have an election. This is the presidential election. They have a midterm election this year as well. The Democrats are going to do very, very badly in the midterm election. From all indications, they are going to lose the majorities. They have the House and the Senate. That means that it's going to be the House and the Senate is going to be Republican, and only the presidency is going to be Democratic. One of the main reasons for this is because of the high inflation rate, as well as the pain and suffering that people are experiencing right now economically. If we go into 2024 with a similar kind of economic pattern, it's going to be a sweep. We'll have a Republican House, Senate, and presidency quite easily. The Democrats obviously want to stop that. And one way they could do that is to try and get themselves back on track. The example I've been hearing from a lot of people out there is that they want to have a Reagan kind of presidency. Reagan started off his first half of his term with Paul Volcker raising rates, causing a recession like this. But because Volcker was able to drop rates in the second half of the term, we actually had Reagan winning his second term as president. The hope among Democrats is going to be that a similar thing happens, that the pain is felt now, and we are going to experience a recovery coming through in 2024. And that's going to basically feed a more positive view on the Democrats in that point. I don't think that is going to be the right economic decision to make, but it may be the inevitable political decision to be made. I'm in the Larry Summers' point of view that thinks that there needs to be a multi-year increase in unemployment to bring inflation under control in America or the US. And that's going to be something I think is going to be too painful, at least in this round, for politicians to handle. And therefore, the pressure on Powell is going to be quite significant to do something about growth. And I suspect that we are not going to hit the high point of expectations for the interest rate in the US, and possibly by start to middle to next year, there's going to start to be some kind of easing coming through in order to get some kind of positive effect by 2024. Again, politically viewed, not economically viewed, but that's kind of like the kind of baseline model I'm working on at the moment. Okay, cheers guys, have a great weekend, and I'll speak to you guys again next week.